Alrighty, let's start. Good morning, everyone. Welcome to Restaurant Finance, Understanding Your Balance Sheet. This is the latest installment in our webinar series. Our goal here is to share the knowledge that Paperchase has built up over our decades of work in the restaurant industry, help to grow your understanding of finances, and in part also grow your business. Today's session will be covering the balance sheet, breaking it down into its elements, and then we'll go over a demo example to talk about how you analyze this for your own business. If you don't know us already, we are Paperchase. We're your restaurant's accountant. We've been specialized in accounting and finance for the hospitality industry for over 30 years. And we're very, very excited to have you on the phone, on the call today. And today we're going to be discussing, as I mentioned, a quick overview of the balance sheet. We'll discuss the relationship between the P&L and the balance sheet. We'll analyze the balance sheet in depth, going over the assets, liabilities, and equity. We'll cover some red flags, and then we'll go over a few important KPIs and ratios. And then finally, we'll open up the session to you all to ask any questions, whether it's related to the balance sheet or a different topic as it has to do with restaurants and finance. If you do have any questions during the session that are burning, feel free to drop those in the chat. We'll try and get to them. But if we don't, we'll make sure that we have time at the end to discuss further. Now, without further ado, I'd love to introduce my speakers today. Today we have Tushar joining us from the UK and Atika joining us from the Middle East. Take it away.
Morning, everyone, and welcome to Understanding Your Balance Sheet. Just to give you a bit of background about myself, I've got over 20 years experience in various industries. I've worked across the globe, worked in shipping, property, infrastructure, and now focusing on hospitality and looking after a portfolio of clients for Paperchase. That entails liaising with investors, owners, and essentially making the accounts, the financials, more understandable so each operator can understand what's happening in their business and use the information more effectively. I'm joined today by Atika, who's my colleague from the Middle East. I'll let her introduce herself. Atika.
Thank you, Tushar. Hi, everyone. My name is Atika. I'm Accounts and Client Manager at Paperchase Dubai. My role is all about making things easier for the restaurant owners and managers in the Middle East. So from seamless onboarding and training to providing financial clarity, I help restaurant businesses take control of their numbers and make informed decisions. And today it's a pleasure to have you here, and I'm grateful for your time and attention. Now my colleague Tushar will walk you through with the balance sheet review. Thank you.
Paperchase provides a couple of key statements. The first one is the P&L on a monthly basis, which shows how much your business has spent and earned over a specific period of time. Most people focus on this because this shows the profitability of the business month to month. Then we've got a cash flow statement, which is optional for quite a lot of UK clients. It's an additional service that we offer. It determines the ability of the business to pay its suppliers, employers, lenders, and so on. It's become more key in the UK since there is a bit of a cash crunch going on in the UK with the state of the current economy. So people are focusing on this more. So if you do want a cash flow statement, please reach out to your account manager and they should be able to sort of talk you through and set you up to receiving this. But the key focus of today is to focus on the balance sheet. And what does the balance sheet show you? It's essentially a summary of the financial state of your business at a specific point in time. If we could move on to the next slide. So the balance sheet is split into three key elements. What the company owes, assets, things like building and cash. What the company owes to its clients, customers, banks, so on. Basically, this would be anything from purchases, supplier amounts that you owe for F&B that have been invoiced but not paid, bank loans, that sort of thing. And then finally, anything that's left over is regarded as equity, and it can be one measure of the value of a business. It's not the only measure of the value of a business. There are various other sort of corporate finance angles that people can take to sort of value a business. And we have a complete separate arm under CFO services that also sort of looks into that and can help you value your business and provide more in-depth sort of analytics on the financial state of your business. But let's dive into the balance sheet. One of the key fundamental accounting equations is this one listed on the screen now. Assets minus liabilities equals equity. What does this mean? This means that your balance sheet, the top half of your balance sheet, so your assets less all your liabilities, has to equal the bottom half of your balance sheet, the equity. If the balance sheet doesn't balance, then there's an issue with it, and you should return it to whoever's provided you with that balance sheet to sort of have it corrected and fine-tuned. As I said, 3 sections in a balance sheet. Balance sheet can be split up between current assets, which are short-term in nature, things like cash, and then longer-term assets, non-current, which are things that last for a long period of time, for example, land, building, etc. Similarly, liabilities can be split between current assets, which are normally payable within 12 months, current liabilities payable within 12 months, and non-current liabilities, which are payable greater than 12 months. Normally, these are things like bank loans, which last for a 5-year period or so. The last section of the balance sheet shows you your equity. This is the money that's been put in initially, plus any amounts that have been retained in the business on an ongoing basis. We're often asked, what is the difference between the balance sheet and the P&L, and how do they interact? The balance sheet, it captures your day-to-day progress of the business, shows you your profitability, and it changes month on month. The balance sheet is a snapshot of your financial health at one specific point in time. They interact with each other, as every transaction recorded in the P&L will be affected by a corresponding asset, will affect a corresponding asset, liability, or the equity section within the balance sheet. So let's do a deep dive into the balance sheet, the various sections, and then my colleague Attika will provide some red flags that you should look out for. We'll go through sort of an example of a balance sheet, and also cover a few ratios that can also help you determine the financial health of your business. I'll just share my screen. So hopefully you can all see this. We've got the 3 sections here, as I said. We've got assets split between fixed assets, longer term in nature, current assets, which are shorter, can be converted to cash readily. If we scroll down, you can see the liabilities, which in this balance sheet they have been called creditors. Creditors falling due within 1 year, and then creditors falling due after 1 year. And then at the bottom balance sheet, you have your equity section. So let's go into the fixed assets. Here you can see that we've got fixtures and fittings, equipment, all that should last greater than 1 year. and hence are classed as fixed assets. We've got leasehold property as well. The way that Paperchase presents the balance sheet, we provide a schedule for each one of these items within the balance sheet, because one number is effectively meaningless. So if you take the fixed asset, the furniture number of 25,473, what does that actually mean? What have you spent the money on? We have a detailed breakdown that we normally provide with the balance sheet, which details the expenditure, when it was incurred, the cost price of that equipment, the book value that was carried forward from the previous reporting year, and also then we show the depreciation. These amounts are per month, because every asset loses value over time. There's only a handful of assets that effectively increase in value and actually can also be revalued on the balance sheet. There would be things like land and buildings, which are not normally depreciated and can be revalued upwards with supporting evidence from a qualified surveyor saying that the value had increased. But you'd need to take that up with the auditors. So you've got cost less your depreciation gives you your net book value to carry forward to the next period. What you can see on the balance sheet is your opening balance of the asset at the beginning of the year or the beginning of the period, less the depreciation, and that equals the 23,377, which should appear as your net book value to carry forward to the next period. Likewise, we do something similar on the leasehold side of things. And then what we will provide is a basic overview of all your assets, leasehold property, fixtures and fittings, etc. I mean, the other things that could go in there, like I said, land and buildings, equipment, and so on. They would form this sort of summarized table. You've got your cost value, your depreciation, and your net book value. So flipping back to the balance sheet very quickly. Sorry. Those are the main fixed assets, longer term in nature, as I said. Scrolling down this balance sheet, we then have the current assets. We tend to split up the current assets between sort of larger classes of line items. So the first one there, highly liquid, you can sort of go off and use it immediately, is your cash at bank. That's supported by a bank reconciliation. So you've got the balance that we've booked in your accounting software, your general ledger. You could have items, for example, not so common these days, but like a check that has been written for somebody, but it hasn't cleared the bank. That would feature here as a reconciling item. You would also have outstanding receipts. The normal one there would be credit card receipts, and I'll go into credit card receipts in detail. And then that should all tie back to your bank statement. It's an important control to make sure that your bank reconciliation is provided on a monthly basis. It essentially ensures that everything that has hit the bank has been booked in the accounting software. Just scrolling down, we then have accounts receivable. So this balance sheet is drawn up to the 31st of December. You could have an asset where, not an asset, an asset, sorry, where an amount is receivable but hasn't been paid. So you've booked the amount on the balance sheet but have not received payment for it. Similarly, credit card amounts, as I said earlier, what happens with credit card amounts if your client has come in on the 31st of December, they've been charged an amount via Amex or Visa or whoever it is, that amount is booked in your EPOS. It's booked as a sale because the diner has actually come in and had the service, but the amount is still pending from Amex. Normally, Amex, Visa take 2 to 3 days to actually pay the amount to you before it hits your account, your bank account. So hence they are sort of outstanding and are still an asset in your book, but you're waiting to receive the physical cash. We do provide a reconciliation to this as well, which in theory, if you shut shop today, it should zero within a couple of days because you would receive all the amounts from Amex and Visa. We've then got Uber Eats, Deliveroo, anything else that you tend to use as a delivery service. That's very much similar to Amex and Visa, where you may have booked the amount within your EPOS as a sale, but the actual physical cash from Uber Eats or Deliveroo has not effectively been received until it's paid a couple of days later. We also provide a reconciliation for that, which shows what is outstanding to be received. And all these amounts are amounts to be received from the various vendors. If you're a new startup and have just taken on a new lease, normally the landlord will ask for a rent deposit. In this fictitious balance sheet, it is 75,000. That balance basically sits there and supports your ability to pay the lease or the lease payments to the landlord. During COVID, quite a lot of landlords went in and grabbed these amounts because everyone had stopped paying their lease rental payments. So that sits on the balance sheet. It's your money, but should you not settle the lease month on month, there is a legal process that the landlord can sort of grab those amounts and use them to settle its lease dues. Next on the balance sheet are prepayments. What are prepayments? Prepayments are a good example would be insurance. You would normally pay insurance 1 year in advance. And what happens is we don't book the full amount of insurance in one go. We would normally sort of book that on a monthly basis. So here's an example with insurance, a 6-month policy by the looks of it. We've got £12,000 booked to the balance sheet in August. In the same month, we booked £2,000. So the premium seems to be £14,000 in total. And then we will book £2,000 month on month to the P&L, dividing up that £12,000 and sort of spreading the cost every single month. It means that your balance sheet amount for insurance should reduce by £2,000 a month, and your P&L should see a charge of £2,000 go through per month. That's an example of a prepayment. And then the final section on the balance sheet, which is quite key, is the closing stock. We record the closing stock number as an asset because should you close shop tomorrow, you can actually go away and sell that stock. You valued it in your business at £6,000. However, if you did sort of liquidate, it's highly unlikely that you'd be able to get £6,000. It may be something slightly smaller. But we also use the stock number for calculating your gross profit in the P&L. So your opening stock less, your opening stock plus your purchases less your closing stock is effectively cost of goods sold, and that over a percentage of sales gives you your gross profit margin. So those are the main key sections. I haven't gone into the reconciliations in too much detail. We could probably leave that to at the next webinar and go into more detail about each individual reconciliation. But now my colleague Atika is going to point out some red flags which relate to the asset side of the balance sheet. Atika.
Sure. Thank you, Tushar, for shedding light on balance sheet review and its important components. So now let's explore the key warning signs in both assets and liabilities. So starting with the assets. So the first one is asset and liability mismatch. So if a long-term assets like equipments or property are being financed with short-term liabilities, the restaurant could face liquidity problems, when the payments come due. Hence, a sustainable balance should exist between asset categories and their respective funding sources. Yeah. Second is a cash flow from operations that doesn't match with the reported profits. So a restaurant showing healthy profits but a weak cash flow suggests that assets like receivables or inventory are tying up cash. So compare your net income with the cash from the operations, and if the latter is still consistently low, there may be, accounting adjustment masking the liquidity assets and the issues. The next is slow moving or obsolete inventory. So a buildup of inventory that isn't turning over, for example, excess of frozen goods or non-perishable items suggest over purchasing, inefficient menu planning, or potential write-offs. Yeah. So in such cases, compare inventory levels with historical data and sales trends to identify the issues. Next is high accounts receivable related to revenue. So restaurant typically operate on a cash flow or short terms credit basis, right? So a large AR balance may indicate issues with collections, excessive credit to the customers, or unrecorded revenue losses. So these are all the major red flags, to consider while assessing the balance sheet. Now Tushar will go over the liabilities section for you all. Over to you, Tushar.
Yeah, sorry, I'm just pulling up the balance sheet again. So we've been through the asset side. Let's have a look at the liability side. Again, the liabilities can be split between current liabilities falling due within 1 year and longer term liabilities falling due after 1 year. The first one there is accounts payable, or effectively supplier payments. These are things that where you've taken the goods and service, F&B, for example, you've ordered, a whole lot of meat, for example. You've got some credit terms with the supplier. The meat has been delivered, but you've not paid for the delivery yet because you have some credit terms potentially with the supplier. The key thing here is to look at your age payables. So here we've got an example of the age payables sort of schedule. We list it by supplier. Most of them should be current or less than 1 month, but you do notice that we've got some that are longer than 1 month. This one here for a payroll software supplier. It could be the fact that you haven't received the invoice. You don't want to pay for it until you've got the VAT invoice. You may have some dispute potentially with them or something that has sort of blocked the payment. The danger with anything getting too old is that the supplier and your relationship will suffer, and ultimately the supplier could put your account on hold for critical sort of F&B products that you actually need. Next, we've got accrual, which is the opposite to some extent to a prepayment. So here you may have a good example would be sort of power utility, where you're using the power, electricity, gas, whatever it be, you're using that, water, using that on a daily basis, but they do not charge you. They produce either a bill monthly that doesn't match up with your balance sheet date, or a quarterly sort of bill that they send through. What this means is you've got to record to keep your P&L from having a huge hit at the end of the quarter, which we will have 3 months worth of electricity or power bills built up. And then if you booked it in one point in time, there will be a huge drop in profit in the P&L for that 1 month. So what we do is we spread that cost to the best of our knowledge, and estimate what the monthly value would be if we don't have monthly invoicing. We book that to the P&L. The other side of that will go into this accrual schedule, or the accruals line in the balance sheet, and sits there. So these are effectively things that you still owe for items very similar to accounts payable, but sort of you've got to accrue for them because you've not received the invoice yet. Wages. This would primarily wages, PAYE, NIC, and pensions would all be, and VAT to some element, but I'll talk about VAT separately. They're all sort of timing differences. Good example, this balance sheet is drawn up to the 31st of December. If your wage run or your payment run for wages was on the 5th of the month, but paid up to the end of the month, then we've got an accruing amount similarly for wages through the P&L, and the other side sits in the creditor's amount, because you still owe that £14,000 to your employees, which will be paid on the 5th of the month, for example. So that's similar with PAYE, which is normally payable by the following month, the 19th. VAT, I'll tackle that now. VAT is normally a quarterly sort of payment. So what you'll see is month on month, you'll be selling and purchasing items. So you'll have your VAT payable on sales to HMRC, your VAT is reclaimable on your purchases on a quarterly basis to, we will record it month on month as the transaction happens. That builds up. You do not need to submit a VAT. Most businesses do not need to submit a VAT return until the end of the quarter. At the end of the quarter, we submit the VAT return, but we've already recorded the liability within your balance sheet. End of that quarter, when it gets paid, the amount will drop, but then it is obviously whatever month it's paid, it then bounces back up, because during that course of that month, you've also incurred more VAT. So that covers off that one. Intercompany amounts, mainly sort of transfers between sites if you've got more than one site. Mainly recharges of staff, potentially wage-wise. You could have costs if there's a building with 2 restaurants, one on the top floor, one on the bottom floor, 2 different concepts, all housed under one building. They share common rent rates, power potentially. It can be split rather than sort of make payments backwards and forwards. They can be passed through the intercompany account, which is like a trading account between the 2 entities. Because they're related, you can pass them backwards and forwards, whoever's made the payment for that specific cost. I've covered off pensions, which is pensions and sort of PAYE, which is the timing issue. The rent-free period. What happens on new leases as well is that you'll have a period where the landlord may grant you a rent-free period. So if your rent was £1,000 per month, for example, and you had a 6 months rent-free period, that rent-free period by the landlord is normally allows you to carry out your refurbishment work while you're not generating any revenue. That's why most landlords, and it's an inducement to sort of effectively enter into the lease with them. So the landlord will grant you a rent-free period for, say, 6 months. That would amount to £6,000 of rent that you should have paid. That rent-free amount that you did not pay, that doesn't get recorded as a credit against any 1 month. The accounting rules say that we need to recognise that £6,000 over the life of the lease. So if it's a 5-year lease, we would then take £6,000 and spread that over 5 years, which means that the balance of £6,000 will be recorded in the balance sheet, but will reduce month on month until the end of the lease, where it would be zero. The last item here in the current liabilities is the trunk. You'll know that recent legislation in the UK, and for the Middle East joiners, this is actually service charge. In the UK, it's actually called trunk because we have a mechanism to pay employees an amount from the service charge. The trunk legislation in the UK, as I said, from the 1st of October changed, and everything should be distributed the month following collection. So this, again, this balance sheet where we've got £200, it's had £200 collected during the course of December. That £200 needs to be distributed to all employees and come down to zero by the time the end of January appears. Hence the liability, because the trunk is not a company sort of pot of money. It's actually payable and owed to the employees. Hence it's regarded as a liability and booked in the balance sheet as a liability or creditor falling due within 1 year. So that wraps up the current assets. We've got in this balance sheet, doesn't show it specifically, but in this balance sheet, we've got amounts falling greater than 1 year. These amounts would, as I said before, would normally be bank loans that span multi-years, normally 5 years. During COVID, a lot of businesses had CBIL loans, COVID-related loans that the government provided. They would sit under longer-term liability if they were payable more than 1 year. And then the other amount that would sit here would be any directors' accounts where the directors have sort of either loaned the business money or taken money out to repay their loan. That wraps up the liability section, and over to Adhika to sort of highlight some red flags for you.
All right. So let's move to the liability red flags that we should spot. Yeah. So the first is high accounts payable relative to revenue. So if payables are growing faster than revenue, then it may indicate a cash flow issues, right? And consistently late payments to supplier can also strain relationships and lead to service disruptions as well. The next is unusual growth in deferred revenue. So while getting the deposits for catering or gift cards or reservations are normal, excessive deferred revenue may indicate a potential refund risks or unfulfilled obligations. Yeah. So if deferred revenue is increasing but sales are not growing potentially, it may suggest, aggressive revenue recognition. Next is a declining equity to recurring losses. So if liabilities keep increasing while retained earnings like equity shrinks, the restaurant may be at the risk of insolvency. And negative equity where the total liabilities exceeds the total asset, it's a major red flag, So these are all potential red flags that we should look up to while reviewing the balance sheet. Now moving ahead to the next slide for you to share.
Yeah, let's have a look at the equity section. So here we have at the very bottom of the balance sheet, just scroll down. We have the equity section. Here we have 266 shares in issue. In the UK, these shares are normally valued at £1 nominal value. So anything paid above 266 for the share normally sits in a premium account. Why would you pay more for a share that is only worth £1? Couple of things. Initially, the business will probably need funding. So funds could potentially be split or paid into the business by the owners, acquiring £1 nominal shares, but paying £10,000 for a £1 share. The balance of that sits in share premium. This then means that every balance sheet date, your business could increase in value, as it has done here. So if this was a 3-year balance sheet rather than 3-month balance sheet, you've got a capital position of 109, then 115 and 147. If you took 147 and divided by 266, your share is no longer worth £1. It's worth whatever it is. It just shows that you can use a balance sheet as a form of valuation. But as I said before, there's a whole host of other valuation techniques, and the most common one being some sort of an EBITDA multiple. But that's probably a topic for another day. What we have here after the premium section is the retained earnings. These are losses in this case of 744. These are the losses that have built up from the point of opening to this balance sheet date and have basically been retained in the business. You then got current year earnings, and the current year earnings are month on month and depends what they are. So those two sections basically make up the last two sections of the equity section. We've now got some ratios, common ratios that would sort of also provide you with some additional sort of insight into your balance sheet and give you a quick health check. The top ones there, solvency ratios. Normally the banks focus on this, and any lender, and it shows effectively the ability to pay back debt and shows how affordable the debt is for that specific business. The top one there, debt ratio, total liabilities divided by total assets. Then you've got debt equity, meaning how much debt there is, total liabilities to the amount of equity you have. And all of these have sort of benchmark ratios that banks sort of look into and set. You then have interest coverage ratio, which measures how affordable your interest is based on the EBITDA that you're generating, and it's calculated by EBITDA over interest. And there's a one further one that isn't listed here, which is the key one that banks look at, called debt service coverage ratio. That is your EBITDA divided by your repayments on your debt plus your interest, just to show how affordable the whole debt, the loan package is, the repayments plus the interest, and can you afford them. Next, we've got the liquidity ratio, which is basically your current assets divided by your current liabilities. This shows the ability of the company to pay off its debt using its existing resources without effectively raising external debt. Then we've got some, Then we've got some profitability ratios that are sort of a mixture. So the first one there is a more of a P&L sort of measure. It's EBITDA over the sales, or net profit over the sales, whichever way you want to look at it. It shows how much profit you're making for the sales that you're generating. And it's quite a good measure of keeping track of profitability. You've got return on equity there. It's more of an investor sort of ratio. It shows how much return an investor is getting for the amount that he has invested. So it's normally net income over equity. And then the last one there, return on assets, is net income over assets. It's effectively showing the return you're getting for the assets that are employed within that business. And then the last couple are more sort of activity. It shows how your assets are turning over. So your net sales divided by your assets shows how many sales you're generating for assets employed within the business. And then receivables turnover, how long your customers are taking to pay you, normally represented in days. So that's quite a key metric, not so relevant, I would say, within hospitality, because most of your clients are coming in and sort of paying there and then, but can be where you're running into the Christmas period and you've got lots of events potentially where people are sort of potentially not paying you deposits or balances quick enough during the holiday sort of period. So those are the key quick and dirty sort of way of sort of looking at the balance sheet as well, and the key ratios essentially. So if you've survived with us this far, I know it's quite a dry topic. If you've got any questions at this point, please go ahead and ask them.
You can go ahead and drop your questions in the chat, or if you want, you can request to be unmuted and I'll go ahead and let you speak. So please, anything related to this topic or anything that you've been wondering about your restaurant or in general about finance, we are happy to answer. While people think about some ideas or things that they want to know, we can answer a few FAQs. If you want to go into the next slide. Tushar, anything that stands out here?
Yeah, a couple of things. So the top one there, what is best practice in utilizing event platforms? Very useful, both for you to know how much you're owed, but also for us, we need to keep track of deposits that are made. So if somebody phones you up and says, I want to hold an event on the 1st of April, you'll normally take a deposit. That deposit is lodged in the books as a current asset. The platform normally has some sort of unique identifier for that person together with their name. It might have a long reference code plus Joe Blogs or something. And it will have the date that the event is actually going to take place on, 1st of April. 1st of April comes along, that person rings a few days before and says, unfortunately, can't make it, I need to reschedule or something, which causes us a bit of a problem because we are looking, you may have lots and lots of lines of deposits received, but it's good practice for you to go in, change that deposit to whatever the new date is, and it helps us track it. So the new date comes along, let's say it's 30th of April. The person comes in, has their event. When you close out the check, you should close out and book that deposit amount now as a sale within the system. The deposit amount, because of the unique identifier, we can match that up with the event and account for it as a sale. I'll cover off the last one because it's pretty much related. So the last one there, why can't party deposits be booked as revenue instead of an asset? Deposits, essentially, the event in my example on the 1st of April hasn't happened yet, and then subsequently gets moved to the 30th of April. So we can only book a sale. It's part of the revenue recognition rules for accounting. We can only book sales as and when the event or the supply of a service has actually taken place. So in this case, the revenue would be booked on the 30th of April as a sale, as opposed to sitting on the balance sheet up to the 30th of April. Debit balance. So just picking off the second bullet here. Debit balances are normally on your accounts payable balance. Basically, it shows that you've overpaid a supplier has given you a credit note, or something has happened that basically means that the supplier owes you, but it's under the liability section, if you remember, under the balance sheet, which would mean that it would be a negative balance in the liability section, which is quite unusual. So it's one thing to keep an eye on. Obviously, ideally, your AP ledger should be 0, but for some reason it's gone into negative, and it's a key control to look at your age suppliers list in order to have a key control over sort of debit balances. And it's a good case to sort of follow up and see what's happened with that. Our team should normally send you a age creditors list for you to review and work through with us. And then the last one there, wire intercompany. I think I touched on this earlier, why intercompany accounts important. As I said before, it allows you to sort of book amounts between different sites without having to sort of shift money backwards and forwards from the various sites. It also sort of covers off potentially wages and any other common costs between the two businesses. So yeah, feel free if you've got any further questions.
Yep, now's your chance. You can drop them in the chat if you have any questions. If you're feeling too shy, you can always email us afterwards, and we're happy to jump on the phone with you and chat through your question. But if nobody else has anything they've been wondering about, we are so appreciative of you joining our session today, and hope that you'll be able to join us for future restaurant finance sessions. If there's ever anything that you want us to cover in one of these sessions, please let us know. We love suggestions. This session topic was actually a suggestion from one of our clients. So please reach out to us. Let us know your feedback. And thank you again for joining us today, and have a wonderful rest of your day.
Thanks, everyone.
Bye-bye.
Yeah, bye-bye.